The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes. Don't I have it on? I don't have the mic. Well, it's just still the Tax Lady, and still our hour to talk taxes. And so if you're sitting out there with all those forms and you don't know what the heck to do with them, EG Tax is here to help you. We have 31 area offices to serve you. Our website is egtax.com. And you can go there. You can drop in a note, question, and we'll be very happy to answer it for you. Tells you where all of our offices are, their phone numbers. And we're here to serve you on WBEN. I'm Esther Gulius, the Tax Lady from EG Tax. Christopher Fabian is my buddy, and he's here. Christopher.
Hello, Esther.
Hello, Christopher. Okay, so we're going to talk taxes, and we're going to be. I'm going to ask Chris some questions that people ask me, and then we can kind of chew them up. But again, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. But I'm going to ask Chris a question. All right, so let's say a client comes in and says, I only have Social Security to live on, and I pay property taxes. Why? What should be important to that person?
Well, for this year and the last 2 years, you would be eligible for the IT 229, which is the real property tax credit through New York State, where they could get back $250 to $350
For each year.
For each year. Yep.
So that I would say to that person, you don't have to file a federal return. That's true, but on New York State, you have money coming, and it's you use form IT 229, and you could have. I do tons of them, don't you?
Oh yes.
Yeah. And if you say, oh, I missed it over the past few years, you can go back to 21, 22, and 23.
Yep.
And get your money back. All right. How about this one? I had a CD, and I broke it, and I took a penalty, and I went to another bank, and I got 5%. What happens to that penalty that they suffered?
Well, that penalty is an adjustment to income, so it's like a subtraction. So you claim the interest earned on the interest line, and then on the Schedule 1, there is page 2, there's a line for an early withdrawal penalty.
Right.
So you would get a subtraction there.
So if you're somebody that broke a CD, if you take a look at the schedule that they are giving you, you're going to see that there was a penalty. That penalty, even if you don't itemize, is an adjustment to income, and you get to take it to reduce your tax bill.
Correct. You know, we got an interesting text.
Okay, what do we got?
I have a friend, who is 53, moved from Texas to New York in 2022. After she retired from working 30 years ago for the Texas state government, is her $50,000 a year Texas state pension fully taxable in New York State in 23 because she became a New York resident at the end of 22? She was told by someone in Texas that since it was a state retiree pension, that it would not be taxable in New York. Is that correct? She had no state tax withheld during the year. Love your show.
Okay, so if somebody retires on a New York state pension, federal or county pension, then that would be completely tax-free to New York, right?
Right.
But if you have another kind of pension or an IRA, then the first $20,000 is tax-free and the rest of it would be taxable. So her pension is not a New York state pension,
Nope.
right?
Nope.
So is it going to be completely tax-free?
It's not completely tax-free. The first
20,000
$20,000 is tax-free.
Right. So that's the answer. The first $20,000 she would take off as an adjustment, but the balance is going to be fully taxable to New York State. If it was a New York State pension, would be different. Federal pension would be different. County pension would be different, but not
Anything
out of state.
Yep. Exactly.
Okay, let's see. We got anything else here?
Esther, I had a new 96% high efficiency furnace and a new air conditioner installed in our home in June of 23. Do these 2 units qualify for any tax benefits? John.
Yeah, they qualify for the clean energy tax credit, and you're going to basically, it's not probably very close, I would assume, would be the $1,200 credit, $600 on each of them. So the new energy credits are a maximum of $1,200, but you can do it every year. And so the old credit was $500 lifetime. Now it's up to $1,200 per year, and you'd put that on the clean energy tax credit.
Yeah.
Right?
Yes.
Okay. I'm Esther Gullius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Our text is 716-8030930. Okay, I'm going to ask Chris another question. Your spouse moved out of the house at the beginning of the year and left you with 2 kids. You have a small job making $15,000 a year. He wants to file jointly with you and the kids. What would you say to that taxpayer?
Well, it depends on your relationship. But if it is a bad relationship,
Well, he moved out.
I
mean,
know, but still they
for
could be
crying out loud.
friends. But since it's I would say no, because she would walk away with about a $20,000 refund between the federal and the
That's exactly
state.
right. So even though they're still legally married, and yes, they could file jointly, there's a stipulation in the law that if your spouse has been gone for more than 6 months and you're maintaining a household for children, you're considered unmarried for tax purposes, and you get to be head of the household, and you qualify for all those credits: the child tax credit, the refundable child tax credit, the earned income credit, and the earned income credit on the state of New York. So this mommy would make out like a bandit if she doesn't file with her spouse,
Exactly.
right? And if she did file with them, what kind of benefit would he get?
Well, they would do married filing joint, which could be a lower tax bracket. They
Although she's going to get the $18,000
yeah,
standard deduction,
Right,
she's
right.
in
So-
good shape. She pays no taxes.
yeah.
But all he's going to get is the $2,000
per
right,
child.
per child.
Yep.
So he'll come out $4,000 ahead. She loses like a ton,
Yeah.
right? But if she really did like him, she could give him part of her money, right? Okay,
Yes.
let's see what else I got for you. Any other texts here?
Yep. Can
Okay.
Medicare insurance premiums be included towards deductible medical expenses?
Absolutely, right?
Yeah. Yeah. Definitely. It goes right over.
But here's the thing that people don't understand. Yes, they're deductible, but will you get any benefit from them is the other question, right? In other words, yes, she can write it off, but if it doesn't come up to where the standard deduction is going to give you a benefit, if your itemized deductions don't exceed that, then even though you were able to take it as a deduction, doesn't mean it benefits you.
Right. Right. I mean, somebody today I had $7,000 in medical, and they were so excited because they thought it would help
Right.
them, and it didn't do anything on their return.
Right, but maybe on New York State, because many times what I'll find is you itemize on the federal, and it may not work, but on New York State, which has much lower standard deduction,
yep.
You get the benefit on New York State. So even though it isn't the full benefit that you get on the federal, you get the benefit on New York State.
Right. Right.
Okay, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back on the other side with your phone calls and questions.
We are family.
Hey, to us, you are family, and this is Esther Gullius, the tax lady, wanting to help you with your taxes. We certainly want to make sure that you learn stuff about your taxes that you never knew before, and you think, oh my gosh, I had no idea. I want to tell you, taxes are not just clear cut. It's like playing bumper pool. Don't you think, Chris? It's like this angle, that angle, that angle, this angle. I was just telling him, I had a client yesterday that had too much subsidy for his health insurance, and he was going to have to pay a penalty. But by simply putting money into an IRA, it reduced the adjusted gross and taxable income, and it got him out of the penalty, and it saved him $2,400. And so the money's in his IRA, and he didn't have to pay his liability, and it just shows you what you can do.
Right.
I'm Esther Goes to Tax Lady, 8030930, 8030930, star 930 on a cell phone. All right, here's another question, Chris. A kid gets his first job and makes $8,000, and he has withholding of $200. His dad wants to know, should he put the tax return, his W-2 on the father's return?
Boy, do we get that question a lot. No. Each individual files their own return. Only time you include somebody else's is when you're married and you include the spouses. But the child.
And kitty tax, right? If there was unearned income.
Right.
Yeah.
Right. But for wages, the child would file his own return and make sure the box is checked that they can be claimed by somebody else.
Right. And the $200? He
would,
$200
for the
withholding.
federal, he would get back.
Right, and because his income is $8,000, he has a very low threshold on New York State for the standard deduction. He would probably owe money on New York State, but he would file his own return.
Correct.
Right.
Yep.
Okay. Why don't we go to the phones? 8030930, 8030930, star 930 on a cell phone, and we got Mark in Buffalo. Hi, Mark.
Yes, I have two questions for you, Esther, on the tax credit for New York State. What were the years that you're eligible for that again?
You mean the property tax credit?
No, yes, the property tax credit.
The IT 229. So it'd be 21, 22, and 23.
21, 22, and 23. Now
do you file a return, Mark?
Pardon me?
Do you file a tax return?
No,
Okay. So do you have any income?
just Social Security.
Okay. How much are your property taxes?
They were about $2,500.
Yeah, it looks like you got refunds coming of $250 to $300 per year.
Yeah, but I only got $45 last year.
Well, no, they must have not done the
Right.
229. They did the IT 214,
Right.
which is the old property tax
Right.
credit.
Right. That
You
was
want to
the
do
last-
the IT 229.
So if I did that last year and I used the old property tax credit form, can I still redo it and get the other
Yeah,
one?
you can amend that return. Do an IT 201X.
IT 201X.
Right.
And that was for last year, and then I could put one in for the year before. I did not apply for
That's exactly right.
that. Okay, what was that again? IT 201X?
You're doing the IT 201 amended X.
Okay.
And you're going to attach the New York I-229 to that IT 201X.
Okay. And then for this year, just do the other one.
And then when you're doing your New York return, you do the IT 229.
Okay, thank you very much.
You're very welcome. Thanks for calling.
Bye-bye.
Bye-bye.
And that's something people should call their senators and say, hey, are you going to extend this?
Right,
Start
because it
getting in
ends
their
this year.
ear now. Right,
Right.
because it ends, 23 is the last year for it. So more people who call, maybe they'll push it through.
That's absolutely true. And is this an election year? Okay. All right. How about this question, Chris? And by the way, 8030930, 8030930 is our phone number here in the studio. All right. Your daughter went to college last year. She's got income from a job of $10,000. She wants to claim the American Opportunity Tax Credit. What do you think?
Well, I would say absolutely not, because she would not get the refundable credit where
Right.
mom and dad
Would.
So, how much were her wages again?
$10,000.
She would save nothing. She
That's
would get
absolutely nothing. That's
$200 on the
absolutely correct.
on the state return.
Absolutely correct.
Where mom and dad would be giving up over almost $3,000.
Right. So mom and dad, if they claim her, are going to get the American Opportunity Tax Credit, assuming she was within the first 4 years of higher education. They would get the $2,500, and again, assuming that there was tuition and fees. But if she did it, she's up till she gets over the standard deduction, she's paying no taxes at all. So it's zero benefit to her. Mom and dad really get shot in the foot. Now, What if mom and dad are listening and they've been letting Susie claim herself the last couple of years in college? What should they do?
Well, just like Mark, our last caller, they should do an amended return and amend hers
And amend theirs.
and amend theirs and get all this extra money back.
Absolutely, because those last 3 years are open to fixing a problem, and there is money waiting for you plus interest. So you want to make sure you do it, right?
Correct.
All right, let's go to Mike in Tonawanda. Hi, Mike.
Hi, Esther. I'm turning 72 this year, and I have a
Happy
question
birthday.
about the RMD. How much do I have to panic, and when do I have to start paying that?
73.
73.
Yes.
Okay,
So you got another
I've
year.
got another year. Now, my
Right.
second part of that is, because I have IRAs and I have 401ks, do I have to take it out of each one, or is it just the total, and then you take and send the government X number of dollars?
Well, your IRAs, if you have more than one, you can put all together and figure out what your collective RMD is for that and take that out of one. Your 401ks, you can do the same thing, but you cannot combine the 401ks with the IRAs to figure out a total RMD. They both have to be separate.
Oh, okay. That's nice to know. Okay.
Okay.
Thank you very much.
And the thing is, when you're making those calculations, Mike, try to take the withdrawal out of the worst performing account. Right?
Okay,
I mean,
thank you.
if you have a 5% CD IRA and a 1% CD IRA, I'd take it out of the 1%.
Okay, great.
All
Thank
right?
you very much.
Thanks for calling. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Oh, I got another one for Chris here. All right, you're a nurse. You don't look like a nurse, Chris. And you received a bonus last year of $1,500 for working through COVID. This year you got the second part. Is there anything you can do to reduce the income on New York State?
Yep, New York, there is the credit, or not credit, it's an adjustment to income. You get to back off that healthcare worker bonus on the 225 on the subtraction line, the 1,500, and it will save you $100 on the
Right,
state.
right. So if you are it's not just even works. It's healthcare workers, right?
Healthcare workers.
And
yeah.
you got that $3,000 bonus, and I had one yesterday. They got the whole $3,000 this
in the
year.
1 year, yep.
So in their situation, they would have been $150
Yeah.
saving.
But make sure it says on your W-2.
Right, it's on the W-2.
Yep.
And I think it says
HCB.
right.
Yep.
Right. All right. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Yes, sir.
I just want to say, looking at a W-2, we train all our staff. Look for 414H. What's a 414H?
Yep, you got to add it back in.
Right. We've seen this year, like charter schools who contribute to it, it says NYSR something. It doesn't say 414H. It says New York State RS, Retirement System,
Wow.
which is the
414H.
414H. So that's good. So if you're a do-it-yourselfer and you see that in box 14, make sure you add that to New York, because they will catch it 2.5 years later and add interest and penalties
Right.
if you don't.
And here's the thing. These contributory pensions, when you finally start withdrawing, they're going to be completely tax-free, but you have to add it back in now on the New York return.
Yep.
Right?
Yep.
Okay,
How about we got another text?
Yeah, what is it?
Please go over the 401k savers credit again. Did you say gross income up to $55,000 for singular filers?
Well, I got to look in my magic book here because everything phases out. But it's called the pension savers credit, and married filing a joint return, the cap is at 73. If you're single, the cap is 36.5. If you're head of the household, it's 54,550, and if it's married separate, it's 36.5, where you could get the pension savers credit or part of it. So it starts to phase out, but when you're in that sweet spot, it's 50% of the first 2,000, which
Yep.
is a heck of a deal.
Oh,
right?
yes.
All right. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Okay, I got another one, Chris. You and your spouse have been taking care of 2 siblings in foster care, and you're thinking about pursuing adoption. What would that couple have to watch out for?
Well, if they're siblings and they're adopting them, they would get at the automatic full adoption credit for both children.
Which is
About
unbelievably a lot.
$29,000,
Right.
$14,500 a piece roughly.
Right. And here's the thing. You get that adoption credit for adopting special needs children. They don't have to be, I mean, when you think of special needs, you think,
Medical.
wow, medical. But sometimes it's a sibling group, right?
Yep.
And even though the county places them in your home for free, you still get that adoption credit, which is, in this case, over $28,000.
Yeah.
That means you don't pay taxes for a long time.
Very
Right.
long time.
All right, let's go back to the phones. 8030930. 8030930. Star 930 on a cell
How
phone.
about we got break
Do
for
we
the
got the
news in a
news?
minute, so
Oh,
we'll
shoot.
wait
All
for
right,
Joe
you know what,
after
Joe?
the news.
Hang on until the other side of the news because I don't want to cut Joe off. Let's do this quick then. I want to itemize on the federal, but unable to since you can't claim business miles, and your business miles of 11,000 haven't been reimbursed. Can you take them anywhere?
Well, yeah, you can take all your business expenses on the state. You can still use your mileage, your cell phone, your business gifts, your dinners, your entertainment,
Job hunting.
job hunting, your uniforms, all that fun stuff you can still take on New York State.
Right. And as a matter of fact, those Trump tax changes that eliminated that are going away this year. In
2025.
Right.
Yep.
I'm Esther Gilius, the tax lady, 8030930, 8030930. And Joe, we'll talk to you on the other side of the news. We're going to break. Thank you.
We are family. I got all
Hey, family, this is Esther Gilius, the tax lady, and we want to help you to make sure you not only pay the least amount of taxes, get the biggest refund, but that you understand why. I think the why is so important, don't you, Chris?
Yeah, you got to understand your taxes. I mean, it's your return. You got to know what's
Yep.
going on. And that's like what we talked about prior to the show, how many people's refunds have dipped and they don't understand
Right.
why.
Oh, yeah. That's because they withheld less. I kind of think that they did it on purpose to give people more money during the
Well,
year
that's-
so that they didn't feel so pinched.
Yeah, I said, well, you got to pay for your $4 loaf of bread, your $3 dozen of eggs, your
Right.
$8 gallon of milk.
Right. All right. Let's go to the phones. We're going to talk to Joe. Hey, Joe, thanks for waiting.
Hello, no problem.
Hey, how are you?
Good. I'd wait for you guys all day. I'm confused, and I want to understand it. I have what I think are two money market accounts.
Okay.
I got 72,000 in one, 62,000 in the other. What I wanted to do was take advantage of some of these ridiculously high interest rates that I'm seeing. So I talked to the person I deal with, and he's like, "Don't put all your eggs in one basket. No way. I would never give that kind of advice. I don't think you'll find anybody that will." What am I doing here? Can you tell me?
Well, what eggs in what basket? I mean, you're just putting it in CDs, right?
Well, I got two money markets.
Yeah, well, that's
And what are they
You can
earning
do
you?
money markets, but you understand a money market can change anytime interest rates change. So whenever the financial institution wants to drop rates, you have nothing. You have nothing to fall back on. You just have to move it, and that's good if you want to move it. But if you're looking, you can actually lock it up for like 4 years at 4.5%.
Right. Okay, I get that part. But the difference between money markets and
A certificate of deposit. See, a CD, they guarantee you that they're going to pay you X amount of dollars for X amount of time. And in that agreement, they say, if you break the agreement, we're going to penalize you. Okay, that's a deal on the CD. On a money market, they just say, okay, we want your money, but we don't want to be held to having to pay you something and stick our neck out. So we're going to pay you the money now. But in the event that things change, we're going to drop the rate.
Right. Okay. And that's totally different than just a straightforward, well, there's a difference between qualified and unqualified money.
No. That's a
No.
dividend. Okay. Interest is in a bank. Interest is in a CD and a money market or a savings account where they pay you nothing. In the investment world, when you're buying into a company, you're buying stock into a company, and the company makes a profit, then they pay a dividend. The dividend is is something that's taxed, but if it's a qualified dividend, then you get a break on the income taxes you pay.
Well, I think what he was trying to explain to me was there's two kinds of money in my accounts. One that I accumulated for working, earned income, and then there's a little pocket of money there's that pocket of money is earned income. Then the majority of my money was not earned through, working.
Are you talking this
A
money
pension?
sitting in a 401k or an IRA?
Yes.
Okay, so your $62,000 and $72,000 is pension money.
Yes.
Okay. So, but it's the same thing. People don't understand that you can put money in your 401k plan if you're or your IRA and have it be a CD. You can do a CD IRA. You can do a CD 401k, or you can go into the stock market, and that works too. It's just the type of vehicle you're using to make money inside your pension plan.
So there is no reason in the world why I can't combine the 72 and the 62 and put them all in one account and move them.
Well,
from
that's
where
not
they are now.
necessarily true. If they're both 401k plan, are you in control of the 401ks and these IRAs,
I don't know what
or
you mean by
does
that.
your employer
Well,
control it?
I don't have an employer. I'm retired.
So these are in IRAs.
Are they in our IRAs?
It's with American funds, and I.
But is it an
No,
I?
it's not- it's
Okay,
not-
so you know what, Joe? Why don't you call us later, 632-7886, so we can talk and maybe tell you where to look and see what it is. But here's the thing: if it's a 401k, you cannot. And you're not in control of it because the employer is controlling it because it's a 401k or 403b. Then all you can do is talk to the financial person handling the account and see if they will, if you have a choice of funds to put it in. If they say no, we're controlling it. They say, Joe, we don't want to deal with you. Go to whatever. Then there's nothing you can do. An IRA, though, is an individual retirement account that you control, and you can put it where you want, as long as it stays in the IRA and you don't take it out of the IRA. You just move it around inside the IRA.
All right, I won't hold you up. I know you get a lot of calls. I'll call you a little bit later when the program.
All right, Joe. That'll be fun. I'll look forward to it. All right,
Thank
we're
you
going to
so
go to Annette. Hey, Annette. How are you?
Good afternoon.
Hi.
Hi. I have a question in regards to a capital gains tax on a second home that was in irrevocable trust. How do they figure out the capital gains tax?
In an irrevocable trust, you don't get a stepped-up basis. It goes back to the donor's original basis.
What does that mean exactly?
What they paid for it plus improvements.
There's
So
no
it used to be, all right, till about this fall, all right? The IRS just came out and said, you know what? If your assets in an irrevocable trust, we will not give you the stepped-up basis. So that
What
means
is
that
that
the
stepped
original
up
donor's cost plus improvements plus expensive purchase plus expensive sale is going to be your basis, and that'll be all. That is compared against what you sold it for, and that's going to be the capital. That'll be the capital gain.
Okay. Is this filed together with our yearly income tax or a separate filing?
No, this would be a trust, a 1041 that has to get filed if it was in the irrevocable trust.
Okay, 1041.
Right.
Yes.
Okay, thank you very much. Thank
You're
you.
welcome, dear.
Bye.
It just, it's so sad because people do these irrevocable trusts, which means you can't do anything about it. You're locked
Yep.
in. And they must have thought they were going to get stepped up bases on these houses. And
Yeah, well, I mean, that's the whole thing with the life estate and everything, too. If you're planning on it being your forever home and you're going to die there, that's one thing. But if I'm going to move in 10 years, don't do anything because you're just going to screw everything up because you lose your personal $500,000.
Which brings me to this. All right, let's say I want to stay in my home, but it's pretty expensive and I'm just living on Social Security. I still owe $50,000 on my mortgage and the house is worth $250,000 or more. If I sell, do I pay taxes? What do you suggest?
Well, there's a couple different things. I mean, if you want to sell because you can't keep up the care of the property, then you could sell. There's no tax on the gain if you're single because it's under $250,000. And there's no problem there. But if you really love your house, you want to stay there, you could actually get paid to live in your house.
And that's something I think people have to understand, that the reverse mortgage is back in play. When interest rates were so low, 2%, nobody was doing reverse mortgages. But this is really a way for a senior to live in a house for as long as they want to by using a reverse mortgage, which will get you completely tax-free money.
Yep.
Because what they're doing is they will give you a monthly stipend off of your reverse mortgage, or nothing at all if you don't want it, but they'll pay off your first mortgage if you have enough equity, and then you can just live in it. All you have to do is maintain the house and you get tax-free income.
Right.
So that's a really important tool in taxpayers' toolbox, tax-free income.
Yep.
Reverse
Yep.
mortgages. Okay, let's go back to the phones. We'll talk to Mike. Hey, Mike.
How you doing, Esther? Last
Good.
week, you get so many calls you probably don't remember, but from my car
I
insurance,
remember you,
homeowners,
Mike.
well, you probably remember me through the years. But anyhow, I got a 1099 from my insurance company, Allstate, and of course, she said call them, and I couldn't because I just got it on a Saturday. I called them Monday. They had a recording. They sent out statements like that to tons of people by mistake, and they were working on dealing with that and the IRS, etc. But in the meantime, if I file, and I file early, and it gets in there, and they don't have it straightened out with the IRS, it's a big problem from everything you've said.
Well, if they correct it, then you would have to do an amended return. And then you would get, if you were claiming income you never received, then you would get money back.
But I think what Mike is saying is he's not going to put it on the return because he knows better. And then is the IRS going to say, oh, Mike, you didn't put it on? But here's the thing, Mike. The IRS writes letters, and they're not love letters, they're letters, all the time where they're questioning the way something was handled. That's where you have the opportunity to show that they should have never sent this 1099 form. And yes, there's kind of a ping pong back and forth, but writing them letters usually solves it, or calling, especially if they know that a corrected 1099 was issued.
If it was issued.
If it was issued.
Right. So if you're
it was.
So if you're anticipating that it is and it doesn't, and you leave it off your return, you're going to get a letter in a year and a half saying you didn't claim all your income.
Right.
So I would put it on and then
Put it on anyhow.
amend it later.
Right.
Okay, or else I'll just push anything to the next year. Well, yeah, like you say, you got to
You can't
amend
push
it.
it to the next year. And what is, it is, you know.
still-
But
I still haven't got
I mean,
a
I wouldn't
return
worry
call
about the
from
correspondence. And
Allstate.
Mike, if you get a letter, you just call us. We'll help you.
Okay, you always help everybody. Thank you very much. You enjoy.
Thank you, Mike. All right. And let's, we got a break. We're going to take a short break, but we'll be back with your phone calls on the other side. I'm Esther Golias, the tax lady.
We are family. I got all my sisters.
Hey, I'm Esther Golias, the tax lady from EG Tax with Christopher Fabian. And we want to help you with your, well, we want to help you with your taxes, right?
Yes. I missed the shout song right there.
I
Too
know,
bad
well,
we
hey,
can't play the Saber song, but
Anyway, all right, well, let's quickly go back to the phones. I want to talk to Mr. Tom. Tom in West Seneca. How can we help you?
Yes, Esther. I spoke with you, I think, about a month and a half ago about a lot that me and my brothers and sisters inherited in Florida.
Yeah.
And the net from that, we sold it for $40,000, but the net, according to the letter from the attorney, the net was $35,000. Now, you said because we had to give our Social Security numbers that we would be getting some form of a 1099.
Well, the letter from the attorney is going to act.
you should have got a 1099-S.
S, right.
A 1099-S, and who should who's the one that sends that to me?
The
The
closing attorney.
Okay, so I have to speak to my attorney to get that form then.
Yes.
Okay. All right. Okay. So that settles it because I usually get my taxes done, and my sister's been bugging me too because she gets her taxes done too by now, but we don't have that 1099, and it's a 1099-S, and I have to get that from my attorney.
From the closing attorney.
Okay. Because I didn't know who was going to send. I didn't know if the government was going to send it or the state of Florida or what.
Oh, no. It's the closing attorney. So it's his responsibility to get it out. Now, if he doesn't get it out timely, that's something where you got to put pressure on him.
Okay. Thank you very much.
All right, you're very welcome, Tom. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Who's our next person, Chris?
Oh, well, I would do a text real fast.
Okay.
I missed the full question about medical debt. My husband and I have a large deductible insurance plan, and we've have about $15K in medical debt occurred last year. We usually file a married joint and take the standard married deduction. Is there anything we can do to claim any or that medical debt? Our adjusted gross income is about $122,000.
So here's the thing. Your medical has to exceed 7.5% of your adjusted gross income. So you could file separately and apply the medical to the lowered income spouse. And so the 7.5%, for instance, if the other spouse was making $40,000, that floor would be less. But unfortunately, if you itemize, your spouse has to itemize, and it may not work out.
Right. But I just was rereading this. It says incurred. It doesn't say paid.
Oh, it's got to be paid.
Right. So the big thing there is paid.
Now, here's the thing. With a lot of these medical things, they're giving you the credit card, that medical credit card. If you put the bill on the medical credit card, it's considered to be paid, even though the debt is now fully not paid. As soon as you put it on the credit card, it's considered paid. But yes, you have to reduce it by 7.5% of your adjusted gross income.
Right. So yeah, you would have medical that you could use towards your itemized deductions if your property taxes and your charity and your mortgage interest
we're high
all put
enough.
you over.
And I'm noticing two things for the Schedule A. The interest rate for houses are
oh my
higher,
gosh.
and so people are paying much more in interest.
Yep.
And secondly, they're paying much more for houses.
Yep. So yeah, a lot more people are itemizing
this year.
Yep.
Okay, what else we got here?
Then why don't we go to Tom in West Seneca?
Hi, Tom.
Oh, okay. Bob and Clarence.
Yes. Hi. I'm wondering if you could envision a way that the reverse mortgage can be used to protect your home assets from nursing homes, whereas if the bank owns part of it or a good part of it, and just doles out the money a little bit at a time, you're somewhat protecting a big bite of your assets. Maybe you're not really thinking this through clearly, but can you see any advantage to that?
No, I mean, because if you're doing a reverse mortgage, the asset's still there.
Right. So if you're taking monthly payments and you're up to $100,000 that you owe in the bank, and your house is worth $300,000, they could still make you sell
I mean,
it.
a life estate is your best bet, because in a life estate, in other words, you can't have your cake and eat it too, because if you do the reverse mortgage, that's going to get you income. But if you're saying I need a reverse mortgage because I need the income, but I want to protect my assets, I really think you need to talk to an attorney about that. But I would think probably a life estate would be the best thing for you to protect the asset, but then you won't get the money. So it's a conundrum.
The amount that the bank says your property's worth, that they'll give you the money on, that's not protected in any way. In other words,
No,
you don't have a contract with the bank.
But the thing is, you don't have to take it all out. You can do monthly payments, you can do annual payments, you can do no payments. But you'd have to talk to the attorney to see if the asset's protected. I don't believe it is.
Yeah. And I mean, even if you take a lump sum out and you have the money just sitting in the bank account,
you're
now
at risk.
Now you're at risk there too. So
See,
you
I
really
thought-
got
I
to
thought-
talk to an elder care lawyer.
I thought what you're doing is you're taking out like a contract with the bank, and they're giving you, say, $200,000 out of your $300,000 home, and that $200,000 can't be touched because you already have a contract with the bank to dole it out monthly, say, for example.
I don't think it works like that, but go talk to an attorney.
Okay. Thank you.
You're welcome. All right, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone.
And we got
All right,
Kevin.
wait, this one I got to do.
We got-
You have an opportunity to make an additional $50,000, and you think it'll put you in a higher tax bracket. What do you think about that, Chris?
Go make your $50,000.
But I'm going to go in a bigger tax
But
bracket.
only the amount over will get taxed at that higher bracket. So if you're in the 22% bracket and you go over by 30,000, that 30,000 is going to get taxed at an extra 2%. So you're looking $600.
Right. I mean, that's the truth. That's what people don't understand. You moving tax brackets, everything is incremental. 10%, 12%, 20%. I mean, that's the way and just that little piece is taxed at that rate. So anytime you get a chance to make money, make it. Okay,
Yep.
Chris.
We got Kevin in Orchard Park.
Hey, Kev.
Hi, Esther. How are you?
I'm good. How about you?
Good. I'm doing all right, but I've got a question for you on the healthcare worker bonus program.
Yeah.
So I'm going to be doing my daughter's tax return, and she got something on her W-2 that it just says New York HWB. But
That's it.
I understand you have to go to IT 225 and put it on there, but the IT 225 asked for a number. It says 14A ES, and then it's got 3 blanks. What would you code that on the?
Well, you have to, there's an the 225, and then there's sub forms for the 225, which you have to pull up too. And on there is a line for the healthcare worker bonus. I don't know what that line number is off the top of my head. I think it's 143, but.
Okay, so I have to find the sub form and put it on there.
Yep.
Right.
That makes sense. Okay, and then I have to amend hers for last year. I used a tax software, and I put the amount in there as an adjustment, but it didn't have a specific code for the HWB. So when I look back, they never used it as a subtraction. So I'm assuming I
Well,
have
make
to
sure you amend that return and put it on there.
Yes, so I just have to go back and get an IT 225 for 2022 and amend. Okay,
Right.
Perfect. Thanks so much for your help.
Right. Thanks for calling.
Okay, we got one more caller. We got Kevin in West Seneca.
Hi, Kev.
Hi, how are you?
Good.
I'm looking to reduce my tax burden for 2023 with some catch-up contributions to my IRA. What's the maximum I can do that to reduce those taxes for 2023?
Well, since you're saying catch up, you must be over age 50. So you can put in an extra 1,000. So you can go up to 7,500 in your IRA as long as you have earned income up to that 7,500.
Okay. Now I'm obviously still working. I'm still contributing to a regular 401. So I've had 401k.
All right,
Okay, well, wait, stop.
Okay, see, wait, the wheels are going to fall off the bus because the minute that you have a pension plan at work, that mitigates what you can put into your IRA.
Right. So how much do you make at your job?
6 figures.
Yeah, you're not going to be able to make a deductible contribution to an IRA.
Right.
Okay.
I'm sorry.
Everything has a phase out. See, they're so worried about somebody being rich that they phase out all the deductions for people as they start to climb up the ladder. So once you get to like 150, 160, 170, 180, they start taking away the deductions.
I see.
Contrary to what everybody thinks.
So there's no other way to shelter any of this. Obviously, some investments, some CDs, and some interest things.
The only thing, the best, did you maximize your 401k at work?
I have, yes.
Okay.
Yeah.
And your wife works?
I mean, into the.
You know what? I can't. I'm running out of time here. I'm going to have to say, call us 632-7886, and we'll talk to anybody. Okay. All right. I'm Esther Gilius, the tax lady from EG Tax. Give EG Tax a call, 632-7886. Visit our website at egtax.com.
Did I pass my test?
Huh?
Did I pass my test?
You did really good. All right. I'll talk to you next week. Bye-bye.